When you hear about a war breaking out, especially in a part of the world that's rich in oil, what's the first thing that comes to mind? For pretty much all of us, it's the price we pay at the pump. The common wisdom is that war automatically means an instant, massive spike in oil prices. But is that really true? Okay, let's just tackle this head on. We all see the scary headlines, we hear the experts on TV, but what does the data actually show when a conflict like this kicks off? And this is everyone's gut reaction, right? War means chaos, it means uncertainty, and it threatens supply. And since oil is basically the lifeblood of the global economy, any kind of disruption should send prices through the roof. I mean, it seems like simple economics. But as we're about to find out, the reality, well, it can be a whole lot more complicated. So let's put this theory to the test. We're going to look at a real-world example, the second quarter of 2025. This was a period just packed with the kind of geopolitical tension that you'd think would send the market into an absolute tailspin. Now, what's so interesting here is that this wasn't just one thing. It was a double whammy of potentially market-shattering events. First, back in April, you have these huge global tariffs announced, which immediately sparked fears of a trade war and a global slowdown. Then, just a couple of months later, in June, an actual war breaks out between two major powers in the Middle East. Honestly, you couldn't have designed a better stress test for the oil market if you tried. So you've got a trade dispute brewing and a war kicking off. Everybody was holding their breath, just waiting for prices to explode. But what actually happened to the price of Brent crude oil? Well, the answer is probably not what you'd expect. All right, so let's set our baseline here. As we entered this incredibly turbulent quarter, the price of Brent crude was sitting at just under $74.50 a barrel. Keep that number in your head. Okay, so about a week into the war, the price did go up, and it peaked at just over $77. Now, yeah, that's a jump for sure. But think about that. For a war in the Middle East, a $2.50 increase is, well, it's hardly the catastrophe everyone was predicting. It was more like a ripple, not a tidal wave. And this is where the story gets really wild. By the end of the quarter, after a war and major trade tariff announcements, the price didn't just fail to skyrocket, it actually fell. It dropped by almost $7 from where it started. So what on earth was going on? So here's the key. If a war wasn't the main thing driving the price, something else had to be in charge. The market wasn't ignoring the risk, it was just balancing it against another, much more powerful force. And that force was supply. The world was practically swimming in oil at this point. You had really strong output coming from OPEC Plus and a bunch of other big producers. And get this, global inventories were building up at a rate of 1.5 million barrels every single day. This created this massive supply cushion that basically acted like a giant shock absorber for all the geopolitical chaos. And this quote from an SW International analysis just sums it up perfectly. The fear of a supply disruption from the war was real, no doubt. But the reality of a market that was just really, really well supplied was more powerful. The market looked at the actual numbers and decided that for the time being, there was plenty of crude to go around. But a strong supply was only half the story. The other, equally important piece of the puzzle was what was happening on the other side of the equation, global demand for all that oil. Remember those trade frictions we talked about? Well, they were starting to bite. You can see it right here in the OECD's forecasts. Look at the numbers. They were revising their growth expectations downwards for pretty much all the major economic engines around the world. The whole outlook for global growth was getting weaker, which meant the expected demand for oil was weakening right along with it. So, what happens when you combine a huge surge in supply with slowing demand? It's simple, really. You get a massive surplus. In that second quarter of 2025, the world was producing 1.3 million more barrels of oil every single day than it was actually using. That surplus created this huge downward pressure on prices, and it completely overpowered the fear generated by the war. Now, if you're thinking this whole situation sounds a little confusing, well, you're not alone. The uncertainty about what happens next has led to this fascinating disagreement between the world's two biggest energy analysis groups. So on one side, you have the International Energy Agency, the IEA. They represent the big oil importing nations. They think we're on the cusp of peak oil demand, and that consumption is actually going to start falling after 2029. But then you have OPEC, representing the oil exporting nations. They see a totally different future, one where demand keeps growing for decades to come. They can't both be right, and this deep, deep divide just goes to show you how uncertain the long-term picture really is. So, after digging into all this data, what's the one crucial thing we should take away from it all? How should we think about this the next time we see a scary headline about oil? It really comes down to this. Yes, geopolitical events absolutely matter. They create fear, they create risk, and that does have an effect on the price. But they are never the whole story. You always have to look deeper at the fundamental balance of supply and demand. Because more often than not, those fundamentals are the real kingmakers when it comes to the price of oil. And that kind of leaves us with a fascinating final thought, doesn't it? This quarter proved that the oil market is resilient enough to absorb both a war and major trade frictions. So it makes you wonder, what would it take to truly send the market into a spin? The answer, as we've seen, probably isn't in the next headline, but buried deep within that complex, ever-shifting balance of global supply and demand.